venture capital, the healthcare VC session, and I did make it out through Marty's reception and dinner, and so here we are. We are going to be joined by one more person. So usually the presentations go maybe 2 minutes, introduction, where you came from, your background, educational and professional background, and then a little bit about where you are, but then we'll dive into it more as we get to Q&As. It's too bad we didn't have a pre-call, but that's the way it goes, okay? You guys are ready for everything. And I got a couple of nice ladies, so how could you go wrong? In fact, I'm gonna get another one coming up, so lucky guy. Okay, so let's go ahead. I'm gonna say, my name is Gary Sawka. I have been involved only briefly in the healthcare industry. I'm USC, Harvard Business School, worked for most of my career in transportation, leasing, corporate venture capital, but I did have financial services, but I did have a couple of tours of duty of semiconductor companies and also biotech. And so that's my story. So ladies, go ahead and start introducing yourself.
Perfect. I'm Rachel. I'm a VP of investments at City Light Capital. I am originally from Alaska. I went to Hopkins undergrad neuroscience, thought I would go to med school, ended up not doing that, went on to management consulting, spent about 5 or 6 years there, mostly M&A work. Ended up actually working for a late stage startup as part of that in the aerospace sector of all things, but really loved kind of early stage company work. And so had always wanted to get back into healthcare. And so got to know a fund that was launching a healthcare focus. They'd actually historically invested in fintech, so a lot of the themes that we were just talking about, but came on for them, was the first hire there, helped them build out the healthcare fund, and then met the team at City Light Capital, where I'm at now. They have a very mission-driven approach to healthcare and a really unique investment strategy in terms of how we invest in early stage companies, and just got really excited about that and came over and joined the team there. Quick version on City Light, we're a New York-based impact investing fund, so look for companies with traditional venture returns, but also where there's measurable positive social impact. About half of our portfolio is healthcare. We do a lot in mental and behavioral health. Originally got our start as a family office, but are now in our 3rd institutional fund, and mostly focus in sort of the digital health world, so tech and tech-enabled services in sort of seed and Series A healthcare investments.
God, that's a great summary. So go ahead.
Hi, my name is Sonia Weiss. Academically, I Tufts undergrad, Harvard Grad School. I have a background in management consulting, worked from Bain & Company for a while, and thereafter basically started researching mental health out of personal interest and passion, just something that affects my family. And 10 years in, we decided to launch a fund after having realized that it was a very interesting time for mental health. We are an early stage VC fund that focuses exclusively on mental health. Initially, we did primarily drug development, but now we're into precision psychiatry, BCI, neurotech, as well as digital therapeutics. We are very mission oriented. We really want to invest in technologies that are drastically going to change either the way we access, diagnose, or treat patients with mental illness.
So I'm going to ask, is there anybody hidden behind the logo?
Not yet.
Okay, so that's fine. Okay, so John's supposed to be coming. So one of the things I'm going to have is one lady is actually taxing over here from her fundraising, and she'll tell you her story, but she's raising a new fund. So it's kind of a little bit different kind of thing. But I think that, when I went to the healthcare meetings, I didn't actually attend any of them where they're the individual presentations. But what I did do is sit out in the lobby where there was the coffee and the teas and stuff. I guess I should have had some lemon tea right now. But what happened is that, there's the old story, as you might know, you got to kiss a lot of frogs. Well, it was Frog Central there. I mean, even the wait staff was getting, hit for pitches and stuff. But since you guys already have an established fund, how do you kind of differentiate with the thousands of people that are trying to call you every day? Go ahead first.
Yeah, so I would say for us, we tend to be very founder driven. So, we have a portfolio of over 100 companies at this point. About 70 of them are repeat founders or CEOs. So folks who are deeply experienced operators. So that's certainly a piece that we look for. Our portfolio is also, I believe it's 47% women led and 34% BIPOC led. So good on those metrics as well. So founders who deeply know their space and have experience building and scaling businesses is one of the big pieces that we look at as we're differentiating. I think beyond that, certainly looking for folks who sort of share our ethos around, wanting to build large, successful businesses, but also those that deliver a lot of impact. And then beyond that, we spend a lot of time going deep in the spaces where we're investing. And so bring some of that perspective in terms of what type of business models usually work or where we think there's gaps in the market and room for new investments. So, we talk about, I think we both spend time in mental health, and there's parts of that space that are really crowded and there's been a lot of investment, but there's also areas where there's still white space. And so, bringing that kind of perspective of where there's room and what's been tried and what works, I think is how we.
Yeah. So that's great. Those, these are good summaries. We're going to get a lot of Q&A by the time we're through because everybody is so summarized. That's just fantastic. Go ahead.
So I think we are very specialized in mental health, so we know the space very well. We know where the white space is. We know we really like to invest in frontier science and solutions that are new, right? We don't like to invest in
I know who you are now.
A new CBT. Those are crowded spaces, and we stay away from those. We really want to invest in things that are new and that are going to target a new population that is currently underserved. And then similarly, we focus very heavily on the founders as well as the team they have built. We want to make sure that they have experience. We want to make sure that they have a clinical development experience, that they've gone through the FDA process, that they know what that's about, that the clinical trial, that they've gone through clinical trials, that they know how to design that. And we also want to make sure that investors are ethical, that they're moral, that they're humble. I mean, we want leaders that can listen, essentially, and we really try to find those amongst the team. I think that's our criteria when investing.
Okay, well, those are pretty good things. Actually, yesterday they just invented a new healthcare indication because, the football, the Georgia's now won a national championship, but the transfer portal of going from one place to another for football players is getting too much. So the NCAA just adopted a rule that says the first time you can transfer without any problem. The second time, you either must, at the second school you want to transfer to, you must have a mental health certificate that there's something buzzed out about you, or that you got a physical injury. So, a lot of these guys keep trying to find a team so they can eventually get to the NFL. So that may actually be a new field because in sports medicine. But, in terms of going around, what do you think is hot now for investments in the areas and what's not hot? Obviously, cancer's been around for a long time. It's kind of a tough one to do. Alzheimer's obviously is very debilitating. There seems to be some interesting things but at a really high cost, and I guess you get to catch it early. So, is that a good question for you two? You probably are pretty up to speed on it. And so go ahead.
Happy to chat about where we're excited and what we're looking at. So I would say for us broadly, like we look in the digital health world. So, technology, tech-enabled services, we don't do anything that's going through the FDA. So a bit of a different world there. But within that, I think, as we both sort of have mentioned, mental and behavioral health continues to be a big area of interest for us. Similarly, many folks on our team have had kind of lived experiences with people close to them with that. So kind of understand that problem from many facets. But we recently invested in a company that's focused on, mental health aspects for seniors and some of the behavioral health issues associated with dementia and things like that. And so that was like, for example, an area within that space that we got excited about because we felt like it's a large market, it's very high cost and continues to be a lot of some white space there. So mental behavioral is a big area for us. We spend some time as well in health equity. So thinking about how we can improve access for those who are often underserved or overlooked by the healthcare system. We're also spending time in areas that we talk about around value-based care, which is a little bit of a buzzword in healthcare, but is ultimately sort of a shift around how providers get paid. And they're starting to get paid more based on value that they deliver versus just how many different, procedures or things that they do. And so that's sort of a large shift that's underway in healthcare. And so investing around how do we enable that is another area that, we see as being both good for the patient and good for the system at large, and is one we're excited about. And then beyond that, we look at, aging or other areas of like large chronic disease. You mentioned cancer, you mentioned Alzheimer's, like areas that are these large cost buckets for healthcare payers, traditional healthcare, because those are going to be the things that are at the top of their list as they're looking at solutions that they want to partner with in the market. And so those are some areas that we're interested in.
Okay, great. Sonia, you have a couple of things to say, and then we'll
Sure.
introduce our next one.
So historically, we've focused in areas. So one of our big focus has been psychedelic medicine and the impact that psychedelic assisted therapy and psychedelics will have in mental health. The clinical results that are coming out of the trials with MAPS and Compass and MDMA and psilocybin are unheard of in psychiatry, where treatment-resistant populations are going into remission, something that hadn't happened before. We're also very interested in everything having to do with precision psychiatry. Psychiatry is where oncology was a few years ago, a few decades ago, where basically you get diagnosed based on symptoms, not based on biomarkers, and sick populations are quite heterogeneous, so they react very differently to the existing drugs. Only about 30% of people actually have a positive experience with currently available SSRIs. So through precision psychiatry, through the use of biomarkers, we're actually starting to be able to better segment populations. And this has an implication both at the clinical trial level, which clinical trials are hundreds of millions of dollars. And so if you're able to power a clinical trial with a lower number of people and know that that's the population that's going to positively react to your drug, then that translates to huge savings to the system. And then once approval is done, it means precision diagnostics. It means actually being able to take the drug that you're going to react to when you react to it. We're also very interested in everything having to do with BCI, brain computer interface, and the use of modulation of the brain to treat various diseases. And on the access side, we're also very interested in everything having to do with remote monitoring, value access care, things along those lines. So I think that's where we overlap. Yeah.
Okay, so that's really good. So my good friend Regina has just come in, and she's in a little bit different stage because she's had a long bio in terms of healthcare and education in larger companies, but then she just decided to start a new fund called Tonic Bioventures, and seems to be making some really good progress. So why don't you give a couple minutes background and education, different places. Yeah, go ahead.
Hi, everyone.
We can also pass you this one if you want.
Hi, everyone. Thank you, Marty. My name is Regina Lowe. I see some friendly faces. Mary Jo Porter. So my background is life sciences. I've spent probably 25 years in healthcare, mostly with therapeutic companies, large drug companies. About 5 years ago, one of my business partners, Jim Sergi, who owns a CRO, for those who don't know, the acronym is Clinical Research Organization.
I think they can hear you.
Yeah.
Thank you. We do clinical work. We came together about 5 years ago. We have a similar idea of forming a venture fund, and hence the conception of Tonic. So we have a unique model. We are a venture formation. We, unlike a lot of other VCs, the ladies on my right, we take assets out of universities, incubators, and accelerators. So we're interested more in the asset than the company. And we wrapped around management services. So we put in our own CEO, usually folks that have been tried and proven is one way of de-risking it. We use a CRO, basically go in and do the clinical and regulatory work, another way to de-risk the model. And then our exits are primarily going to be M&A and licensing. So we invest in therapeutics as well as devices and diagnostic. So we look for corporate strategics, like a Daiichi Sankyo, a Chugai, or Johnson & Johnson on the therapeutics, and then a BD or a Thermo Fisher, whatever the flavor is on the device side for exits. So that's kind of our model. Any questions?
So before we got, before you got here, I talked about Frog Central for people in all the conferences that I attended outside the actual presentation. And so it seems like rather having to go and listen to all of those people, that you've got a much more unique model because you've already got some of these that are pre-vetted already. So at an early stage, I guess that's really good. And so that's fantastic. So, you know, I think we had at the earlier one, I don't know how the audience, whether they want to hear the overall or these very specific things. But in the prior presentation, we did have Matthew here from KLL Gates, and he talked about the fact that in the life science phases, he still saw a lot of deals being done. But, you know, those are deals that already a guy's got enough money to at least pay a lawyer's fee, right? It's not like these are guys that are just still at the early stage telling stories and who knows how they got into the conference. So that's the difference. So I think we'll go ahead. Let's go backwards this way in terms of Sonia first. So we go this way and give Regina a break in terms of what do you think of the overall fundraising? Do you need funds? Are you looking for more funds, or are you really got enough? Or do you see other competitors coming in? Is it going to be more competitive or what?
So I think in our specific sector, we are currently fundraising for a second fund. One of the challenges that we're seeing is the public markets being so discounted. So a lot of our investors are looking to create a short-term public equities basket with the idea of exiting perhaps in a few months and then going back into venture with that cash. Having said that, we do think private companies have been lower in adjusting their values, but we are seeing early stage companies adjust their values. And I think especially in life sciences, early stage companies generally come in with some sort of grant money, and data. So that's advantageous for the life sciences in the sense that they are to a certain extent funded, and they're funded with non-dilutive money. And that allows them to get some of the initial IP work done. It allows some of the initial research to be done, and it allows them to come in with more of a signal and more of a product than perhaps in other industries. So yeah.
So I'll answer from two perspectives, I guess, what we're seeing with startups in the space, and then also from a venture fund perspective. So in terms of startups, certainly the fundraising market's been a little bit slower. We've seen fewer companies out there raising. I think there's just uncertainty, right? We're sort of in the midst of this reset that's played out in the public markets, but takes its time to sort of fully work through private markets. And so with that uncertainty, a lot of companies are just keeping their heads down if they don't need to fundraise. That being said, there continue to be a lot of opportunities that we're excited about. And I think in the past few years, there's been a lot of capital moving into digital health, and some of that will move out of the space, and fewer companies will be funded in a way that will reduce some of the noise, I think, overall that we've been seeing in the past few years. So, not all bad things from a venture fund perspective. So we're thinking about raising our we have 4 Series A funds. We're thinking about raising a second kind of small seed fund, but it's a relatively small amount of capital relative to overall what we do, but kind of a unique product in that we invest out of our last fund in over 100 early stage companies. We'll do 200 out of this fund. So think of it really as sort of a private market index fund, but certainly similar to, I think, what's been said, it's a bit of a different funding market on that side than it's been historically.
What's the size of that average investment?
So typically we're writing about a $50,000 check there. The way we think about this is it's access. It's a way to get to know teams and spend more time with them, as a way to have more reps with them before we look at it out of our Series A fund. So really it's just about having that kind of foot in the door and having that option value for writing a larger check later.
Usually the first investor.
We're usually coming in as part of like the first or second institutional round. So often, they might be raising like $2 to $5 million, and they'll bring in a lead for, a few million of that. And then they're looking at like angels or other smaller investors to fill out that round. And so that's where we come in as typically as part of those. So at the seed stage, we're always a co-investor, and, we want to make sure that the companies are well capitalized, because we're not certainly, the largest check in those rounds. And then for the Series A, we could be more of like a lead investor. And so coming in a larger way there.
Co-investors or lead investors?
Lead.
Lead?
We do both,
Yeah.
depending on the deal.
So Regina, you probably get a lot of feedback from the incubators or the universities. So is that, there's obviously a lot of these that go down, coming up on the 280 freeway, there's hundreds of buildings, it seems like, that are being built there. So how do you try to, do you get people calling you from the university, or do you kind of differentiate there, because does that give you sort of an edge in terms of selecting people?
Yes and no. So as Mary Jo here sitting in the audience, I'm very active. I live in Berkeley. So I'm very active with the UC Berkeley Accelerator called Skydeck. I am an advisor there. I do it for pro bono as a way to give it back to the community. So absolutely, I know some of the cohorts. Healthcare is a percentage of the Skydeck's portfolio of companies of each cohort. So I do see those. We are agnostic how we source. We source globally. I'm actually working with 3 Japanese companies. The Japan ecosystem, for those who are familiar with it, is very hard to basically get anything out. Their mindset and their education system basically makes it really difficult. But there's a lot of very interesting technologies coming out of Japan right now. Cell therapy is one area. There's some very cutting edge coming out of Keio University. And also one of my partners, Jim Sergi, who's the president of our CRO called CSSI, they've established probably in 2 decades. They have been working with a lot of accelerators and incubators globally. They just struck a deal over in Korea with the Korean government and helping kind of promote some of the early stage companies. So deals is not going to be a problem for us. Everything in our DD process is starting with the science. So if the science isn't good, we stop talking.
So beyond that, last at the alpha strategy, I had the question, I said I was 60% short, pretty much anything you can short, but 40%, including some biotech, but it was actually big pharma. It seems like in the biotech and other public companies, I heard one thing that said 300 biotechs have less than 1 year of funding left. And I see a lot of them, they're down to $1 or $2. And so I don't know if they've even got up to phase 0 yet. Maybe that's why they're so low. But I'm wondering, let's start with Sonia. Do you see these as opportunities? I noticed one small one actually got a few $1 million and the stock doubled or something from 50 cents to $1. Are those mining opportunities because, they have to publish a lot of stuff in public with the SEC, or is that stuff that is not in your bailiwicks?
So again, we're a private equity fund, but having said that, I think it's more asset-based than company-based. I think if some of these companies have assets that might have failed some clinical trial, but that there's still something that could be rescued there, or if they have underlying assets and the reason they're trading below cash or have such little cash is what's actually hindering their valuation. I think those are opportunities to acquire the assets for better funded companies. I think just a company, a shell, has no value to it, right? I think it's more about the assets and the data around those assets.
Go ahead.
Why don't you finish your question? I have an audience question from the internet.
Okay. So go ahead, Rachel, and why don't you opine on that?
Yeah, so we don't do as much in the or really anything in the biotech space, so less to opine on like that specifically, but I do think there'll be opportunities in the coming years as there's, assets that are distressed or go under for, may not necessarily be in our wheelhouse, but for, more growth stage or private equity type investors to roll up some of those. And I think there'll be some interesting, technology or healthcare services businesses that get tucked into those. And so will probably be something interesting to do there, but probably less in our wheelhouse.
Okay. Gina?
Yeah, someone who was experienced when I finished graduate school, joined a medtech company. It was Kleiner Perkins funded. We burned 80 million down to the ground. So understand, this is the time you go for those assets. We were fire sale to CVS Health. So I know that model actually lived it. So this is actually a great time, I think, to look for interesting assets. Our other additional criteria is if we're interested in any company, that asset has to be what we call multiple field of use. So it could be an asset that, maybe one indication in oncology, but may have a neuroscience, application. So if regulatory fails in oncology, we have a backup. That's the stratification.
That's good. Oh, okay, go ahead and say the audience question.
Our motto as a group is that we like distressed owners who have unimpaired assets. I
Okay.
think that's a beautiful situation. Somebody who's got to sell, but the asset's a beautiful thing.
So this one's from Gudrun. So it's the same question she asked on the last panel. What are valuations today versus 6 months ago? In particular for companies who have no revenue. So that can be a company that's at later stages of FDA approvals, but still hasn't generated revenue to have a licensing agreement. Any thoughts on that? What are you seeing valuation at right now?
Want to give it a shot?
We have companies that come to us, they are raising Series B, but they have now economics that are 1A extended. So that's what's happening in the market. I don't know if you ladies are finding that.
Yeah, so I think what we've seen, I mean, certainly public market comps in digital health have come down pretty substantially from, a 10x revenue multiple to 2 to 5x probably generously, in the last year or so. And, that's been starting to make its way through private market valuations as well. I think where we sit at like the seed and Series A, it's still sort of in the process of flowing through. Like we've definitely started to see some of that, but I think there'll be more that we continue to see right now. It's very bifurcated. I think there's still some deals that are getting, the type of multiples they might have a year ago. Some of those are things, 50x revenue multiples in some cases even, but certainly that's no longer the norm. And I think we're starting to see things move much more down to kind of in the realm of reasonable, with the realization that as they move into their growth rounds, they're going to start being valued much more based on public comps. And so, we're looking for companies that are sort of well positioned and with that reality in mind.
Okay, Sonia?
I would tend to agree. I think most of our companies, some of them have already started raising at flat rounds or slightly appreciated rounds. Very few have managed to get those outsized multiples, but I think that's going to come down. And especially as companies see, going back to the previous question, the companies that are starting to see their cash dwindle are faster to act and to be able to reduce their valuations. There's others that sort of fundraise or are fundraising just as sport. They don't actually need to, and those tend to lower their valuations. But I think, as anything, as soon as you feel like your asset is going to be distressed or you're going to have no negotiating power, that's when valuations come down.
Valuations, are they down 20%, 50%? Any thoughts?
Everything I've seen across the board.
No perspective.
Yeah.
And also, we've seen an explosion of bridge rounds.
Mm-hmm.
Everything. Everybody comes to me with a bridge round, $5 to $10 million, 20% discount to the next round. It's amazing. Everybody's got the same pitch book or the same pitch. You're being coached by the same person, right?
But is that a bridge to nowhere? Because, can they get another round?
Be trained to LA.
Okay. That is a tough thing in terms of fundraising, isn't it? Yeah, the high-speed train is right. I think the mortality tables will get anybody who voted for it back 20 years ago. So, the cost element in healthcare is, particularly a problem, I think. And, you see a lot of people concentrating. And I was with a drug company that I was there and left to go back to a transportation leasing company. So I was a really flexible guy. But what happens is they were Questcor Pharmaceuticals that later got bought by Mallinckrodt, and there was a whole issue there with opioids, although of course they weren't the only ones. But what happened is they were also pricing a very a drug that they revived and then stay alive on infantile spasms, was pretty high drug for kids that hit 0 to 1, but then there was OMS, which was infantile, really the from 1 to 5 infantile spasms, and there was only like, I don't know, 500 cases a year on something like that, and the infantile spasms like a couple thousand cases. So what it seems like, at least I've read about it, and you can comment, it seems like a lot of people are concentrating on a indication that's got such a small population, and then they're charging like $4 million for a drug, and it's about 20% successful. And I think there was one guy in Iowa, and he said the cost of just that one drug that Obamacare or whatever was covering doubled the cost for the whole state of Iowa. And there's a decent amount of people in Iowa. So, is that, how do you handle those? Because it seems like there's a lot of money. It might not even be a duopoly because no one else is going to want to go into that, but they put a lot of money in it. It's such a small indication. And the reason I ask you is because my grandparents came to Canada. They were like working class parents, and the other guys moved up, but they weren't billionaires or anything. And in the once it got cold in Canada, they'd come down to United States and have some operation that they couldn't get in Canada because they allocated the call. It wasn't that they couldn't get it, but it's like 6 months or 12-month wait, and by then it's kind of getting more serious. So what do you think about that whole issue? Cost, rational medical costs and stuff. What do you think about that whole issue from sort of a government standpoint? UK does it, and lots of people do that. Go ahead, Sonia.
So this is not my area of expertise. We don't do rare indications. I think there is an incentive in the US. Very few people would go for rare indications if there weren't incentives to have a profit down the line. I think that's the case across drug development. It's incredibly expensive to develop drugs, and unfortunately the US bears basically subsidizes the rest of the world that has a centralized health system. Having said that, most of the healthcare costs actually don't come from drugs. They come from hospitals and doctors. They're just harder targets to write about, especially for drugs that are not rare indications. So I think, clearly the solution would be some sort of central, like if Obamacare was actually centralized and they could have some sort of negotiating power. But I think there's a very thin balance as to how do you incentivize researchers and companies to go for rare indications that are so small versus keeping costs down, right? So I do think there's a real balance there. I think companies, if you only have a couple thousand, 20, 50, 100,000 potential patients across the US, then is it really worthwhile to go through all the risk of the drug development if you're not going to profit on the other side? So I do think it's a very nuanced thing, especially around rare indications. But I don't know. I think you also need to look at the healthcare system as a whole and not only drug development and drug delivery.
Yeah. Rachel?
Yeah, I don't have a ton to add on that. We don't know much about biotech or certainly rare indications at all, but I think from the, what we've seen a little bit from our lens is doesn't sort of address total cost of care, but thinking about other ways that, some of these high cost drugs can be financed, and, some of the other challenges we see even for things not at that like very highest tier, but they're just, often a patient will only stay, or a member will only stay with a certain healthcare insurer for a couple years. And so there aren't always these incentives to invest around things that may drive like long-term cost reductions, but in the, immediate term are much more expensive. And so we're starting to see people think about like some mechanisms for managing that and for financing some of those solutions. So maybe a bit of a different take, but just some of the things we've kind of observed around that.
So, Regina, I know you went to University of Warwick for your biology degree or so, but you also lived for a few years in the UK, and you probably, both you and your parents had some experience with that kind of care. So maybe you can, opine on this subject and also your experiences there.
Yeah, first maybe talk through the US system. As someone who spent part of my career at a small company called Gilead, we were actually defending our drug, which is a cure, by the way, in hepatitis, fighting the insurance company. So I lived that battle for about 2 years. I think my only one comment on the increasing drug prices is unless there are interventions within U.S. Government as one, there's absolutely no incentives for the payers, which are, I call them the money bag, people who actually pay, right, for your copay, offset, co-insurance. There's no incentives for those guys to change. It is a very lucrative market dynamics for them. So as Sonia mentioned, I think in US, a rare disease is anywhere between 500 to 1,000 to up to 5,000 is considered or constituted as a rare disease. So if you think about a drug manufacturer's perspective, right, you have, let's say, a patient population of more than 3,000, which means your clinical trials, right, is going to be substantially less because there's just less, patient population for that drug. So if you do the calculation, your clinical drug trial expense is substantially cheaper than a drug that's equivalent in oncology. So what the market has done is it allows, and there's a certain loophole, right? If you go into rare disease, as you alluded to, Gary, earlier, you can command what I call a high price premium and favorable reimbursement. So what drug companies have done is a calculation, right, to offset, hey, my clinical trials expense is a lot less, but my pricing and reimbursement is very favorable. So that's a no-brainer. So now you're seeing a slew of, right, kind of drug companies gravitating opportunistically into rare disease areas, if that makes sense. As far as my UK experience, everyone knows government pays NHS. NHS over the years have improved. Actually, one of my Warwick University professor unfortunately died because at the time he was trying to get a heart valve transplant. There is a massive, massive backup in the system because it's completely overloaded. So I think since then it's revamped, but it's one of the downside of having a government insurance provider that is over capacity. I think they've improved that, like I said, but that's unfortunately, the situation.
Okay, so yeah, that's the old issue about having a nationalized drug vote in the United States. Where would the Canadians go to get their health care? But during the pandemic, I'm in Kaiser probably by mistake because the last employer had Kaiser, and it's all by Zoom or whatever thing they use, and I didn't think it was that good, but the guys who were doing this teledoc type thing were just booming like crazy, and the doctor, he says, Gary, don't drink so much coffee, get more sleep, lose some weight, get more exercise. I mean, okay, if you guys can figure out how old I am, I have no goddamn problems. Maybe it's because I married 50 years, maybe in spite of it, but it was really hard to physically get an appointment. So, and I thought it was much lower than seeing this guy in person, but yet these guys were booming like the teledoc guys, but now they're kind of collapsing. So, maybe we can talk with Sonia. Do you see investments in there? Do you see that they got overpriced? Is that kind of everything away from actually seeing the guy? Maybe you're talking to some guy in India or whatever. Is that a good deal? Or do you think just to get more people for routine stuff?
Honestly, this is an area I don't know. I don't think I can have an opinion. This is probably better answered by you.
Yeah, I would say I think COVID was a strange moment, right? Because we went from almost no telehealth to, I think it was up to 80x or something like that, the telehealth rates basically overnight. And so, I think that certainly probably drove, implications in a lot of those companies' valuations. I think overall, we're probably in this sort of early innings of thinking through what type of role virtual care can and should play. There's certainly benefits that it, in some ways may be able to improve access or have other benefits, but there are clearly times where it makes the most sense to see the patient in person. And so I think over time, we'll start to see more nuance around how you triage which patient it makes sense to see virtually, which patient it makes sense to see in person when. Are there other things around remote patient monitoring or things that you can pair to really extend that care? And so I think we'll just continue to see more there. I think, it's stabilized at 38 times telehealth has the level pre-pandemic. And so I think certainly some aspect of that's here to stay, but I think when and where that's used and how it fits with in-person care is going to continue to evolve.
Okay, Regina, do you have a comment?
No.
No comments. Okay, maybe okay, so we can go through another round of different questions, but maybe what happens is let's take your one and also any from the audience, because I think we've covered a lot of things. Maybe after we finish with your question, then we'll get some audience or maybe some subject that you'd like the people on the panel to go through, okay?
So my big bugaboo is that people come to me all the time and they're asking 10 million, 20 million, $30 million for a round, right? And I'm saying, so what's the market capacity? Like I start asking business questions, right? And they don't have the answer. I'm like, well, isn't 10 million a lot of money? I don't know. But did you ever feel that way when you're asking you for, is it ever part of your, or do you feel it's the VC's responsibility to do the due diligence on the market capacity, or the market size? Any thoughts?
I'm happy to start and then turn it over to you guys. I mean, I usually feel like the founders should know more about the space that they're building in than we do, right? Like we need to certainly be smart, but like, for me, I would be concerned if someone like didn't deeply understand the space that they're building in and couldn't answer some of those questions. I think the way, there's been so much capital available in the past few years that I think, there's been companies and founders that have been able to raise without really having to do the type of work and diligence that they otherwise might. And so I think some of that will probably shift, and like we certainly expect that of like founders that we invest in always. But I think there'll continue to be more of that, and there's more of a focus on unit economics, and there's more of a focus on some of these like business fundamentals in a way that like there just wasn't as much in the past few years.
The way we work, because we're so sector specific, we know the market sizes from the onset. And so we do only work with companies where we know the market potential, the market size, the market dynamics, and we already know it quite intimately. We know the competitors, we know what's on the pipeline. And just for drug development, depending on the stage, $10 million is not that much.
Right, it's not that much for the drug, but it's a lot of money for the family offices.
Yeah. And I think that's where maybe a more diversified or a fund comes in, where you're able to allocate across many drugs and have a diversified portfolio.
Bingo. So Sonia just spoke. So we actually have a diverse portfolio, Marcy. So we do medical devices because it's shorter time horizon to exit and smaller. Yeah. So smaller check size, generally 1 to 5 is what we would put. But for therapeutics, right, it's a bigger risk, but bigger reward, but longer time horizon. So you look at those and you try to make the best decisions, right, for that.
And my follow-up question is, it always irks me that people come to me with these large demands. I'm like, and like they have a drug that it was capitalized, it failed, they're recapitalizing. I'm like, isn't there like any data on this? Like, can you guys talk about the data in the marketplace? I mean, do you grow it yourself? Do you have to collect other resources you go to collect the information? Because we have Tom Farb who's spoken. I come out of the AI space. A lot of people here from AI. Right, and big data, machine learning, and you're seeing an explosion of that in healthcare now, right? And it's like, why isn't data better? I mean, if you've got machine learning, but all the data is bad, it's no good, right? So, I mean, do you guys ever think about that when we're coming? Like, even when you come out of FDA testing, how do you know what's right? I mean, labs have such bad quality assurance. And any thoughts? Data. The question is data.
I'm happy to speak a little bit like less on the sort of like science data, because it's not what we play, but a little bit of like how we use data. One of the things we've done, because we have a portfolio of so many early stage companies, part of how we manage that, part of how we source those is through some proprietary data tools that we've built that ingest, all of these kind of public market sources, other sources, and we use that to help us identify companies and get like an earlier signal of a company that might be being formed or be out in the market. And so, for us, like that's part of how we think about data. But within companies, like often, it is more of a challenge, I think, understanding like from the, when they share results with you or something or outcomes data with you, like it is harder to validate that data in some cases.
So on the data side, scientific data, we use our CRO obviously to de-risk. And so I just finished working with a company, and They have a, phase 3 drug. And what is interesting is they think the phase 3 results are statistically significant. But when you actually ask the question, is it clinically significant? And the answer is no. So I think you have to really start asking those questions, right? I mean, what's out there in the market? What's available as a drug? How is your new drug compared to those, right? The existing marketed drug is going to be your benchmark. Is it clinically significant? That's a very different question from, right, statistically. So I think those are some of the answers that comes with experience, and that we use our CRO to help kind of sift through those.
Before we get to that one question, I did want to mention data is very important in like the semiconductor conference, and I always go there to try and find new things. You've seen just in energy management how a cell phone used to be really big, right? And now, I mean, I just got this one. I'm still trying to figure it out, the Apple 14 Pro Max. But what happens is that the last time I went to the thing, they said they're going to make the Tesla battery that will be able to last 1,000 miles and only be able to and be charged in less than an hour. Now think of these poor guys that are buying one that takes you a couple hours to fully charge, and the battery cost and stuff is going to go down so much, but a lot of that's energy management, just like you see in the house and stuff. And so I don't know if the National Registry of everything people have wrong with them, will help in terms of data if they want to collect it. I guess there's a lot of privacy issues there. But yeah, wrapping your hands around some of that stuff, in addition to having the national registries and stuff, are often important to even see how many people have the disease or reactions. But it seems like if you want to get drugs to the market quicker, you have to do I guess you called it Operation Warp Speed. The Trump administration put billions of dollars into something to make the drug before they knew it was successful. And if it wasn't successful, they would have had to destroy it all. So that's a pretty tough thing to accelerate, 6 months or a year earlier. You see China's problems with, their drug. And hopefully we won't run into too many unvaccinated guys from China here. But really, seriously, they have, no, this is a serious thing. This is a serious thing. At 2 conferences, they required an on-the-spot COVID test here because of the Chinese conference. So they might be scared one way or the other. So I think that if you want to spend a lot of money and before you get to trials, make it also, it's a big population to instantly go into it. But otherwise, I guess at some point in time, you're going to run out of money, right? So I guess it's just the cost of how quickly you can get, how much resources you want to get in, and what the right allocation of money is.
So I do think you can use data to speed up and make the trials more effective. There's not a lot of public data because most companies don't make the data public or aggregate it in any sort of fashion. There is a privacy problem. But I do think the whole movement around, there are companies that are focusing on creating large databases of MRIs, of EEGs. I'm coming from the mental health space. I know something similar is happening in oncology. And I think as we gain a better understanding of how these diseases, how heterogeneous these diseases are, and how to segment these diseases in a better manner, you're able to, a lot of what takes a lot of time in clinical trials is the amount of people that you need to test it on, as well as the recruiting process. It's very slow to recruit the population. So if you're able to identify, power a clinical trial with a lower number of people, then that's just going to save you money and time. And the way to do that is through this big AI databases that are trying to really segment disease and really trying to identify what populations are going to react to a particular drug and which aren't. And I think that's where one of the areas, I think data is going to play a huge role in drug development and healthcare, but I think that's one of the main areas that's going to actually allow us to have much more precise treatment and much quicker route to market for these drugs.
Okay. There's a nice audience question. First of all, I want to thank you for being so patient. Okay, but speak up a bit so we can actually hear the question.
Respond to Marty's first question. benefits of being here for the week is you see some new things I had not seen because I've filed PitchBook and Crunchbase. There's something called Syndex, CYNDX. I saw the demo of it. It's going to supersede PitchBook and Crunchbase. What they can do from a business analytical standpoint, especially for the investor side, is quite phenomenal. So that's just I have nothing to gain. The second thing around the clinical trials, one of the biggest problems, as you know, is $1 billion, 12 years, something called Stratios. And they have an AI-based, basically machine learning-based process to cut about 80 to 90 days per trial, which translates to big dollars. So those of you in the bio space, I'm more med tech, health tech, but I find the platform fascinating. So those just are a couple of sides that you might.
The next pitch to our group 5 years ago. We don't know about that. You have a question for this great venture capital now? Eric?
You know, this kind of more focused on early stage. Phase 2 company. It may not be what you're comfortable with. Feel free to just say.
In terms of valuations, I don't think I can have an opinion. In terms of asset validity, I think, so I think one big thing that fails when you go from a phase 2 to a phase 3 is that even though a phase 2 might be effective, somehow they change the clinical design for phase 3 and add way more noise into something that was sort of already proven out. So I think it depends a lot. I think you have to have a lot of visibility as to how they're thinking about their phase 3 prior to doing that jump. In terms of valuation, I honestly don't have an opinion in those assets, just more on the asset and how to think about it.
So I've actually got a question because it seems like, you know, you look at the drugs that you take and there's all these things that could be side effects that some guy, you know, ran into a telephone pole because he took the drug or something, you know, but that was because he was on this walking around, you know, talking on his cell phone. I mean, you got to have every damn thing in the registry that something's happened. So, but there's also something that it seems like it's worthwhile, this sort of testing of, what is it, the drug cocktail that if you're taking, and if you go into some places, people are taking 20 pills or something like that. And while none of them in and of themselves make a difference, he may have some strange pill that they haven't talked about the combination that could lead to a bad effect. That could happen, you know, eating different types of food and stuff like that. So what do you think about that research? And is that something that's a promising area?
I don't know much about it.
Okay, you guys know. I guess I'm watching too much Doogie Howser. You know, I'm watching too much. I may know more than I'm not gonna say I know more than you, but no, there's a lot of questions, and you guys supposed to be answering them. Okay, that's a great answer if you don't know anything. We're gonna have a lot of fun here, right?
The only thing I'd say, and maybe it's just to get back a little bit to like the healthcare data questions as well. Like one of the things we're seeing on the digital health side is better healthcare data interoperability is kind of one of the buzzwords of the moment. And, you know, historically, like a lot of the data sat in Epic and Cerner EHRs, and it's been historically really hard to get that data out. Some of that's getting a little better. The data is getting more standardized. And so like that enables kind of better analytics, better information in terms of like designing healthcare products, I think across the board, but also enable some of these kind of preventing some of these type of issues of like drug interactions or things that might be prescribed by different providers. And historically that information those systems haven't talked to each other. And so trying to bridge that is one way of hopefully, you know, addressing some of that.
I mean, so my comment is that, you know, it's amazing what's happening in diagnostics these days. The AI is so, I live with a doctor, she goes in to see a patient and AI takes notes, it's recording the conversation, it produces notes at the end of the doctor visit that should be used. She doesn't have to do anything. So that it's truly amazing. So I also know that there's a crime database, so there's a real-time crime database that a lot of people who live in cities use. It says there's active crimes happening at this address, do not go there. And I'm wondering when that's going to happen with airborne illnesses and stuff like that, where somebody says, oh, there's a big, outbreak of XYZ, they'll go there or something like that. If people are coughing. I mean, it just seems like those databases might be highly valuable.
Any comments?
Yeah.
The IRA Act, Inflation Reduction basically made it a lot of assets coming over. How do you take advantage of that?
You guys have an idea?
Gina? It's actually very important because, you're right, all of a sudden that the rules of the game changes. Alabama would have won another football game if would have actually probably been a national championship game if the last play of the game would have been abolished in 2 of their games. So what happens in this case then is do you change the rules later? I guess that's part of life, right? You hit a red light and you're running late or something. But is there any comments on that one, or have we pretty much got all the audience questions taken care of?
There's none online, but you have a question?
And I can actually provide a response to that from the request of that. What interested in the question. So, I mean, as far as I understand, all this stuff seems to be biologics, small molecules, when the first version actually start in the that's going to probably shift focus to those assets. Because now you're going to have 13 years. Price freedom versus time for small molecules. Something else that's kind of obvious now is that official development strategy where you go after first smaller indication, which you can do more rapidly because as we heard earlier, right, you don't see the smaller patients get a signal for approval, the accelerated pathway of the FDA, and then from there go to a larger indication. But because the clock will start ticking, as soon as you get your first approval, actually minimize the time you can really monetize on a larger indication. So the development strategies will probably change. That company will only focus on large indication, which unfortunately will slow down innovation. It may actually use the focus that we've seen in recent years, right, on alpha-1,000, which was very, very lucrative and very capital efficient to get into the market. So these are kind of some of the ramifications. But I mean, it's not going to kick in. It's probably going to be modified somewhat, or actually comes into effect. But it's certainly going to be very meaningful. That's not just for pharma, right? We're marketing the launch of drugs. So pharma is acquiring this small companies to realize also that's they're effectively they're conduits to the market will actually be facing. So there will be ripple effects to the innovators as well, which will provide.
Got another question from Tom?
So I apologize.
Yes.
Already asked, but what single technology do you think will have the greatest impact?
Attempt that. I think on the clinical side, it will be big data and AI and actually being able to segment patient populations. On the preclinical, I think it'll be use of organoids and similarly human-celled organisms, which will allow for, I think it will allow for translation from preclinical to clinical to have a higher likelihood of success, much higher likelihood of success.
Also maybe more of that because of recent FDA.
Yeah, so that's actually our thesis. When we look at a human potential for any of our asset, as most of the people in the audience know, that's a really good point. We actually, one of our advisors is ex-Merck, ex-president of Merck Animal Health. So animal, as you all know, doesn't have FDA requirements. It's a low-hanging fruit to have proof of concept. And you can do an M&A, just to show, right, that there's activity before you transfer that from animal health to humans. It's just a lower bar.
Okay, well, thank you